In this video, we're going to continue to talk a little bit about financial statement analysis. And in this particular context, we're going to look at leverage and profitability. I think we don't need to really define profitability all that much, but let's think a little bit about what leverage means, right? Leverage refers to borrowing. It's the use of fixed cost financing to fund the operations of the company. So since creditors generally have first claim to the company's cash flow, this is obviously very important, not just to the creditors to make sure that they can receive their claim, but also it's important to the shareholders to understand what risks they're taking when they invest their money. Now we have two basic questions we need to ask. The first question would be, how much debt do we actually have? And the second question is, once we know how much debt we have, do we have or can we pay for the debt that we currently have? So let's take a look at the first sets of ratios for leverage. We really want to look at, again, two questions. The top part of this slide is the first question, which is how much debt do we have? And then the bottom half refers to the ability to pay question. So let's think about what these ratios represent. DR is the debt ratio, and this tells us, again, it's total debt divided by total assets. Since we have a balance sheet, this represents the percentage of assets that have been purchased by borrowing money. And of course, the larger the number, the greater the debt ratio, implies greater debt. Now, we don't want to say whether this is really good or bad, and I think this is where many people kind of get a little off stray, right? Is that, everybody says, well, the company shouldn't borrow money. That's not true. All big corporations borrow. So the question is more, in this case, is the company's amount of debt, does it make them too risky to make investments? The second ratio, the debt equity ratio, looks only at the right side of the balance sheet and just references or illustrates the percentage of long-term financing in debt divided by the percentage of long-term financing in net worth or shareholder equity. So it only looks at long-term debt, doesn't look at short-term debt. So again, this just gives us the relationship between the two long-term financing things that are available. So let's think about this. This is a percentage. The debt ratio is a percentage. It has to be less than 100%. But the debt equity ratio can be more than 100%. You can have more long-term financing than you do long-term shareholder investment. So when you look at these ratios, they should be in percentage form. And again, don't be alarmed if the debt equity ratio is greater than 100%. It just says that when we look at long-term financing, the company typically has borrowed a lot more money than what they have with respect to gathering shareholder money. Now, the second set of ratios here represents the question, again, of can we pay? Now, the first, quite frankly, it's the most often used and represented number for leverage is TIE, which is times interest earned. It's EBIT, earnings before interest and taxes, divided by interest. Again, the bigger the number, it just says that there is more profit, more operating profit, than there is interest. And if you think about how an income statement goes, right? We have sales, then you take out cost of goods sold, gives you gross profit, take out operating expenses, gives you earnings before interest and taxes. The next thing out is interest. So again, the bigger the number, it appears the greater the company's ability should be to make payments on their interest. Now the cash coverage ratio is more of a cash flow number. It adds depreciation. We could also include amortization here. It includes depreciation with operating things. So this is really operating cash flow divided by interest. If you really wanted a true representation of my ability to pay, you have to look at cash and not profits. And again, this number would give us that cash representation. So let's look at a company. Again, here we have the debt ratio, and we have the debt ratio of the industry. As you can see here, here's the debt ratio, the blue line, orange line is the industry. So in this case, we can see that the industry, when you look at the percentage of assets purchased to buy assets, this company has less leverage than the industry does. The industry has a tendency to borrow more money. Now, when we look at how they borrow, if you take the debt equity ratio, we look at this, we see that, again, the gray line is the company, the yellow line is the industry. So we know that the industry borrows more, and indeed they borrow a lot more in long-term debt than they do shareholder debt. So again, the relationship here basically says that in general, the company that we're analyzing here has less debt. That means it is in a less risky financial position than what the industry is. Just to add one more time, right? That doesn't mean that it's good or bad, right? The company can have low levels of debt and not be able to make payments, right? This just shows us, again, the picture of how much debt do we actually have. Now to look at the other ratios, here we have the TIE ratio. Here's the TIE ratio. And you can see here, here's the industry is below and the company is blue. And you can see, except for this 1 year, we see that the industry has a very high TIE ratio here, but in general, it is lower almost across the board. So it's showing that in general, the company here has less ability to make payments on their debt than the industry does. But the industry is on a downward slide. So there is a definite decline over time in ability to pay by the industry. And the company, again, with the exception of 2016, has kept pretty steady. I don't know how we would really want to analyze that. We can make just the general statement that, well, it appears that certainly this year we are almost dead on what the industry is. So they have more debt and they have the same ability to pay as the company does. I don't know whether that's necessarily good or bad. It's just a position. Now, the one thing to take into consideration with all of these how much are you able to pay numbers is it doesn't include principal. So the only thing we're looking at here is interest expense, right? So again, this particular ratio, it doesn't include principal and it also doesn't include cash. When we go to the cash coverage ratio, we see that, again, we see the same basic line, but also the numbers are a little bit higher. Why are they higher? Because it's cash. So we have 7 times more cash than we need to cover our interest expense. So this company should have 0 problems with trying to make payments on their debt. So some other ratios that we might want to look at we have what's referred to as net debt to enterprise value, right? So you take net debt, which is the total debt of the company, plus any excess cash and short-term investments, and you divide that's net debt. Divide that by enterprise value, which is market value plus net debt. So again, what do we know from this? This just tells us of the total company's enterprise value, of the total picture of what it would cost to buy this entire company. How much of that, what percentage of that is debt? Of course, the lower that number, the more valuable the company would be to anybody who would want to purchase that company. Now, we also have some equity multipliers that we'll use throughout some other ratios and other analyses. But the equity multiplier is just total assets divided by the book value of equity. So this is just the relationship of assets to equity. This is the reciprocal, if you will, of the debt ratio, which was total debt divided by total assets. So this is one minus the reciprocal of that. Again, it is a picture of leverage. The bigger the number means there's more assets relative to equity, which means more of the assets have been purchased by borrowing. So let's go on to the next stage, which is to talk about profitability. Again, there's a couple of things we need to keep in mind when we think about analyzing income. First, we need to be aware that there are non-cash items that we need to understand and kind of get a feel for what impact those things have on cash. And probably most important, I think we need to think of profitability a little differently, at least with respect to the income statement. We need to think about profitability as a measure of management's ability to control expenses. The greater the profitability number tells us that management is able to control the expenses within that profit line item. So let's look at the income statement items. And we have 4 of them. 3 are probably pretty familiar, and the other one maybe not so much. But gross profit margin measures management's ability to control the cost of goods sold. So it's just gross profit divided by sales. Gross profit is sales minus cost of goods sold. So again, the bigger the number means management has an ability to control expenses. And this is a very good reason why we don't compare dollar to dollar, because a bigger company by definition will have more dollars, and that doesn't necessarily represent any control or ability to make any evaluation on performance. Operating profit margin is EBIT divided by sales. It looks at all of the expenses for running the company. And as I've mentioned a few times, there are some misconceptions about what costs or what expenses are part of running the business. There are 2 sets of expenses that are not related to the business at all. Let me repeat that. They are not related to running the business at all. And that is interest and taxes. Taxes, we got to pay regardless, so we can't make any changes there. But interest has nothing to do with our manufacturing. Interest has to do with our financing policies. So operating profit margin is a picture, if you will, of our ability to measure the profits, the control of the expenses of actually running the company. Now, net profit margin is net income from recurring operations divided by sales. This is essentially what we refer to as the bottom line. That number obviously is very popular. People talk about profits. This is typically what they're talking about. The challenge with this number is that it really doesn't identify the control. It incorporates interest and incorporates taxes, right? But it doesn't tell us how well we're controlling any of the primary expenses of the company. Now we also have EBT divided by sales. This is just earnings before taxes divided by sales. Frequently we leave out taxes because everybody has to pay taxes, and especially large corporations, the marginal tax that they pay is the same for all of them. So with this tax rate being the same, you don't get any additional information by going one step further in the analysis of the company. So we'll see how this fits into our graphic depiction here. So let's look at operations of the business, right? The blue is gross profit margin. That's the company. The orange is the industry. And we can see for this company, the industry, although the numbers are very flat, they don't change much. What we see is that the company, or the industry, is slightly more profitable than the company is. When we then look at operating profit margin, and across the board, it doesn't matter which year you look, we find that the company now is more profitable than the industry is. So what does this tell us? Well, essentially it says, look, when it comes to production, although they're very close and very stable, the industry is able to produce the product at a better profit margin. They control the expenses of production better than what the company does. But when we look at the overall operations of running the company, the industry is more profitable than, the industry is more profitable than the industry. So those other expenses, the things like salaries and marketing and research and development, all of those, we control those expenses better than what the industry does. So now let's look at the bottom line. EBT divided by sales for the company industry. Obviously, we still have blue and orange. And we see that in general, they're very close together. But you might say that in general, the company is more profitable, bottom line wise, than what the industry is. The industry is orange. Now something, again, we mentioned this a couple times, something happened in 2016 that we might want to explore. I've reviewed the data for this company. The data is correct. So the number is correct. But something happened. We might want to explore a little bit more what happened there. But you see, in general, both the industry and company are very similar. And likewise, the net profit margin, it doesn't change. It's fairly stable. So it looks like in the ballpark, we're around that 11-12% range on average is the bottom line profitability of the company. So now we want to switch gears and talk about the balance sheet. Again, there are some ratios that we need to explain. Some are familiar, some maybe not so much. One of the things that we frequently talk about in business is something called ROA, return on investment or return on assets. Many business people talk about this number. And as long as we're talking about our company and what we do inside the company, and as long as we don't change our financing mix, that is perfectly fine. There's no problem with using that number. But if you want to compare it to any other entity, or if you change your financing mix, this number then becomes problematic. The reason is return on assets is net income available to common shareholders, which means it includes interest. That's a financing question. So do we want, if we're looking at how the returns that we make on our assets, do we want to incorporate an expense in there that has to do with financing? A more structurally correct measure of operating profits for shareholders is to look at what's referred to as basic earning power. BEP is earnings before interest and taxes divided by total assets. And again, these numbers will be relatively close. The graphs won't be dramatically different. What will be different, though, is when you try to make comparisons to an industry or to a competitor when they have different financing mixes. As we noticed up above, the industry has a lot more debt than what the company does. That is going to have an influence on ROA, but it will not affect basic earning power. When we look at return on equity, right, it's the return that goes to shareholders. Again, we have net income divided by net worth. This is the profit as a percentage of investor investment or shareholder investment. We also do the EBT. Notice I have the ROE in quotes here. And that's just because for some companies, again, we notice that we don't incorporate taxes. Again, since most companies have larger corporations have the same marginal tax bracket. But again, the higher the numbers here, the greater the profits. BEP is the greater profit that's created by using the assets that we've purchased. For return on equity, the greater amount of profit that's created by using investor money, shareholder investor money. And of course, everybody's familiar, I hope, with earnings per share for the company. And we'll look at that a little bit later on when we look at some of the market ratios, because we want to show the profit relative to some market numbers. So let's look at basic earning power. As you see here, the industry has a higher percentage of basic earning power than the industry company, rather, except for one year. So we would say we would really want to look at, well, what is creating this? It appears we're not making enough earnings before interest and taxes, although we've already said that operating profit margin is higher. So what this is sort of telling us is we really have to look at the assets of our company. Do we have the right asset mix? Now, as long as we're consistent, and the numbers look fairly consistent, except for 2016, we know that we're not going downward, we're not changing or declining necessarily, but we might want to look at how we can increase some more profits given the asset base. And again, in this case, it might be the asset base is suspect. If you look at return on equity, again, the orange here is the industry and the blue is the company. And again, with the exception of the last year, the industry is showing more profit for its shareholders than what the industry is doing. So, or what the company is doing, I'm sorry. So in this case, again, profitability is an issue when we're looking at being able to generate profits based on some balance sheet line items. Now, another way to kind of analyze return on equity is something referred to as the DuPont Analysis. And this might help us understand where the issues might be if the numbers are bad. And again, what we're saying with the previous analysis is that this company is not performing as well as the industry. Well, where is it that we're failing? So here's return on equity can be expressed as three ratios. We can look at profitability, that's the net profit margin. We can look at asset management, that's total asset turnover. And we can look at leverage. In this case, what we're looking at is something referred to, we had a little bit earlier, it's called the equity multiplier. Now when you multiply these ratios together, right? Net income divided by sales, multiplied by sales divided by total assets. Sales divides out, so now we have net assets, net income, divided by total assets. That's really return on assets. Now we multiply that by the financial leverage multiplier, total assets divides out. So in the end, this ratio is net income divided by common equity, which then says, look, if you want to increase profitability, you have to increase one or more of these three things. You have to increase profitability, overall profitability of the company. You have to become more efficient, right? You bought assets, you need to generate more sales on those assets. And then finally, you need to find a way to increase the leverage of the company. Now that sounds a little strange, and in later videos when we talk about long-term debt, hopefully we can bring this concept of increasing leverage increases profitability. Hopefully we can bring that into focus in another video. So here we go with the DuPont analysis for the company. Again, down here, these are the approximate ROE. So you see that the company is less across the board than the industry is. So why is that? Well, let's look at the line items. Profitability. The industry almost across the board is less profitable than the company. So that's not it. The financial leverage multiplier. If you look across this, you see that in general, the company has less leverage. So one way we can increase our return is to increase our leverage ratios. In addition, if you look at our total asset turnover, our efficiency, we see that the company is less efficient. So if we can increase efficiency and do something with our financial structure to increase our financial leverage, we might be able to increase the profits that go to or belong to our owners. Now finally, we had mentioned earnings per share. We know how we calculate that. It's just net income divided by shares outstanding. Now shares outstanding represents those shares available to the public. They're already in the public's hands. This is how many shares have been issued and are currently owned by investors. So in this case, if you think about it, it's the profit per share that's owned by a person. What is dilution? Well, one of the ways we can say is, well, how can you make earnings per share better or higher? Well, there's two ways we can do that. We can increase net income, which I'm sure everybody would like to do, or we can decrease shares outstanding. So if you want to increase earnings per share, technically there's only two things you can do. Increase net income, decrease shares outstanding. But what happens when a company issues shares? If profitability stays the same and you issue more shares, earnings per share goes down. There's less money per share in profit going to owners. And frequently owners will get a little upset with this because they're concerned, obviously, with the profits that are available for their investment. When we get to talk to later videos where we're talking about equity and leverage and gathering funds, we'll address this dilution issue a little bit later. But if you look at the company's earnings per share, you can see that historically it's been fairly stable. It has had some increase, right? We know 2016 was a big year for profits for some reason, but also we went from $2.12 to $6.53 from 2015 to 2017. We see that increase is pretty substantial. Almost, it's over 3 times the profitability in just 2 years. So again, something is happening in this company between 2015 and 2017. Hopefully, we would be able to find that in annual reports, etc. Now, the PE ratio measures how investors view the company's opportunities, the company's future. And you can see here that there's been some increases from 13 to 15. There were increases in optimism, but since then there's been a decrease. Now, why the decrease? Well, the ratio that we'll talk about a little bit later is market price divided by earnings per share. So if earnings per share goes up, PE ratio, everything else relatively the same, the PE ratio will fall. So we have to take that into account here. Doesn't necessarily mean something is bad. It just means that in this case, owners are less willing to invest big dollars in the company for the profits that they think they're going to receive in the future. So again, look forward to seeing you in the next video.